Okay, everybody, so we are still on chapter 20 and we're covering operating leases. And so I gave you a handout. It's got 5 practice questions for you and I'll go over them in a minute. Try them out. Bless you. You want a paper copy? No. I got a picture of you. Not personally, I wasn't there, but somebody sent me one. I was outside the window. Okay. I didn't see you on there, so I'll make sure I check, but Okay, we're ready to go. All righty. A single lease expense is recognized on the income statement for, and so that would be an operating lease. If you are the lessor, you have operating lease expense, and if you're the lessee, if you're the lessee, you have operating lease expense. If you're the lessor, then you would just have depreciation expense. Yeah, this one's a long one. We've kind of had this set up before, and what they're asking is, from the viewpoint of Yates, what type of lease agreement exists? So Yates is the lessor, and the term non-cancelable lease is 3 years with no renewal. And I believe I didn't see any bargain purchase option on there. The fair value is 1.6 million. The machine has a remaining economic life of 10 years with no salvage value. The machine reverts to the lessor upon termination of lease. Alt depreciates all machinery on a straight line basis. Alt's incremental borrowing rate is 10% per year. Alt does not know the 8% implicit rate used by Yates. So it's kind of hard to tell which one it's going to meet because we don't know the useful life. We know it doesn't transfer ownership. We don't see bargain purchase. The lease term, we don't know. The present value of lease payments. So it says the fair value is 1.6 million. I put in the lease payments amount, 3 future value, we get 1.572 million. So if we take the 1.6 million and we multiply it by 90%, we have more than 90%, so it meets that one. So it would be classified as a finance type lease. And so it ends up being a sales type lease because that's from the lessor perspective, sales type lease. Now it says immediately after signing the lease, Yates finds out that Alt Corp is a defendant in a suit that's sufficiently material to make the collectability of future lease payments doubtful. So the way that would work is that affects the collectability of it. And so when they get payments, it's not related to liability, or it creates a liability going forward. When a lease is classified as an operating lease, no asset or liability is recorded by the lessee, only a rental expense. No, that's not correct. The lessee records the right to use and a lease liability. That is correct. Under the operating lease method, the lessor, so now we're talking about who's leasing it out, no longer reports the underlying asset on its balance sheet. So that's not true because we didn't transfer it. Realizes the gross profit on sale of asset? No, because we're not transferring that. Continues to recognize the underlying asset on its balance sheet and recognizes lease revenue. So that's C. And in an operating lease, the lessee records just a lease expense. Still have to figure all that other stuff out. You just don't get to record it. Any questions? Okay, moving along. So this is very similar for the lessee in terms of the setup for it. They set up a right to use. We check the test. If it does not meet any of the classification tests, it means that they're not taking ownership, right? The tests are all the same. And if it does not meet any of these, it's going to be classified as an operating lease, which we're going to be talking about today. For leases classified as operating, the lessee records a right to use asset and a lease liability at commencement of the lease, similar to the finance approach. Unlike a finance lease, the lessee records the same amount for lease expense of each period over the lease term. So it's just a straight line method. So if we record the entries, when we put it on the books, we're going to debit. right of use. Sometimes I put right to use. Sorry if I'm using the wrong adjective there. And then a credit to lease liability. And that's for the present value of the lease payments and any guaranteed residual value. So if we were going to make a payment on the date that we purchase it, it would be a debit to lease liability and a credit to cash. Now, these are the same steps, but I pulled this out of your textbook. So this example will be exactly the same as the one in your textbook. So first we have to do is create a schedule for the effective interest method. But really what we want to do is inform our lease expense schedule. And so the interest on the lease liability and the amount that we're going to reduce the right to use for the asset is going to be broken up. But remember, for the lessee, we're only reporting lease expense. So we're not really reporting interest expense on it. It's part of the total lease expense. So if we're going to record entries, we would debit lease expense and we would credit right to use. And in this case, from this example, we have 17,620 and the right to use would be 15,682 and then a credit to lease liability. Of the 1938. I'll take a look at example one and I'll walk you through it. And what they're looking for here is what is the amount of income or expense before income taxes that each would record as a result of the above facts. Keep in mind that it started in 2025, but they're asking for 2026. So we don't have to make any half-year adjustments. Okay, so as the book is lessor, and so they're going to record 80,000 times 6 months, and that equals 480,000. Then they're going to record 100,000 times 6 months, and that is 600,000. Now they have to record depreciation expense, which is 6.4 million. And I think it's a 5 year? Oh, 8 years. 8-year period with no salvage value. So 6,000. 800,000. And so this is an expense. So I'm going to put it in at 800,000. And so our I just gotta fix this real quick. Okay, so our total here is 280,000. And we know that Emily paid the 480,000 and we know Terry paid the 600,000. And so our answer is A. Take a look at example 2 and I'll walk you through it. Okay. We're asking, at what amount is a lease recorded on Hanover Healthcare Systems books on January 1, 2025? So we look back at the detail, and that's the first date where it happens. And so we have to look and say, okay, we know it's going to be part of a present value of an annuity due because it's made on the first date. The implicit rate of interest contemplated by medical equipment leasing is, and known to Hanover Healthcare, is 8%. So we're going to use the 8%. So we take the 250,000 in payments. We have 4 periods and we multiply it by 3.57710 and we get 894,275. Bless you. Example 3. Now we still have the same information here. Bless you. So this information is still the same. Take a minute to read it, and I'll walk you through it. Unless I block you and don't let you read it. Okay. So what this is asking for is, what is the reduction to the carrying value of the right to use asset for Hanover Healthcare Systems for 2025? And so we have 894,000 lease liability. And then we have the lease payment, 250,000. And it says that we know that their rate is 8%. So here we multiply the 250, I'm sorry, the 894,275 by 8%. Okay, sorry, I forgot. So this first year, right? This isn't 12/31, this is on 1/1. Sorry about that. So this is gonna be 0. And then the reduction on the lease liability is 250,000. And so this lease liability is gonna be 894, 275 minus the 250,000. I forgot to account for the initial payment. And that's 644, 275. And now we get to the 12/31/25, and we still have the $250,000 payment. Now we take the 644, 275 and multiply by 0.08. And we end up with 51,542. And so the reduction in lease liability, 250 minus 51,542. And that equals 198,458. So all the things that we learn how to do with the finance type lease, except for here, we don't have to worry about amortization of the next step. Oh, don't take your time. I can give you another minute, but you got to watch out for Valerie. She shanked a guy at Vita. We had to cover it up. No, no tax fraud, but somebody brings you in the wrong documents, you could just stab them. You're welcome. All right, so now we're moving to the lessor perspective. So over to the lessor perspective, and we have, remember, the asset on our books, and then we also have the lease payment. So if we get the payment received, we debit cash and then credit unearned lease revenue. So we're treating it like a deposit in advance when we generate a lease and we are the lessor. We have the obligation to provide that service. We did not sell or are not likely to sell the asset. And so it stays on our books. What adjusting entries do we have to make? We have to make when we earn. So at the end of the period, we record a debit to unearned lease revenue, and we credit lease revenue. And then, of course, you guys are familiar with depreciation, and it's just the standard debit depreciation expense and credit accumulated depreciation for the asset. So it's much easier to account for it if you're a lessor. It's not difficult if you're a lessee, but it just makes everything easier with an operating lease. Okay, so now we have example 4. And so we want the journal entry for Hanson that makes, including the debit at right for use. So it says we have 240,000 in payments, 5 annual payments. So we've got 5 periods here, and fully agrees to guarantee 150,000 residual plus residual. And we have to find out when do the payments start? Okay, beginning January 2, 2025. So this is an annuity due. And so we're going to multiply. It knows Hanson's rate, so we're going to use 8%. And so we have 240,000 times 4.31213. And that's 1,034,911. And then we have to calculate the residual value because it's guaranteed. And so that's 150,000. And that's the present value of a single sum. So we're going to use the 68508. I'm just clicking buttons up here. So 150 times 0.68508, 102,762. And we add, and we get 1,137,673. Any questions there? Okay, let's take a look at example 5. I'll leave that part up there in case you need to catch up. Okay. Gary Company leased a machine to Dane's company. Assume the lease payments were made on the basis that the residual value was guaranteed and Gary gets to recognize all the profits. At the end of the lease term, before the lessee transfers the asset to the lessor, the leased asset and liability accounts have the following balances. If at the end the fair value of the residual value is 11,800, what gain or loss should Danes record? So we have the fair value, and that equals 11,800. We have to subtract the book value, which we have at 16,000. And so we have a difference of 4,200. And in this case, the fair value is less than the asset. And so there's a $4,200 loss. And so what they did was they structured the lease and the lease liability so that it would have the guaranteed residual value at the end. So if somebody was to ask you what that was, that's that 16,000. But it's only worth 11,800, so they're going to have to pay out the $4,200 additional, and that's why it's in as a loss. Take a look at example 6. And so we want to know what amount will be reported for Mercer's right of use asset at the commencement date. And so we have the present value of payments, which they call the initial measurement of the liability, 150,000. And then you have commissions. So we're going to add commissions to lease negotiator. And so that's 2,000. And then we're going to add the prepay. And that's 10,000. And then we exclude internal engineering costs. So our total is 162,000. Now, one of the ways I kind of keep that in my head when I think about it is if we were to own it, we would be able to report that $5,000 there, the engineering costs to get it to prep the building. And so on a normal process, if we're buying that, we can capitalize that 5,000. But because this isn't an asset that we have as a finance type lease or as something we're going to be taking ownership of, we have to exclude E. Any questions? Okay. Let's look at example 7. Okay, so it's asking what should be the income before taxes derived by Maris Company from this lease for the year ended December 31st, 2025. So I always want to check the year. Purchase a machine on January 1, 2025 for $2.5 million for the express purpose of leasing it. So that helps us because we know that they should still have a year's worth of depreciation because they're using straight line, 5-year life, no salvage value. And it leased the machine to Dunbar Company for $750,000 a year for 4 years. But it did it on April 1st. So we have January, February, and March that the asset was not in service. Maris incurred total maintenance and other related costs under the provision of lease for $25,000. Harley paid $750,000 to Maxis on our Maris on April 1, 2025. So what should be the income? We have revenue, and that's $750,000. And we're going to multiply it by 9/12 because there's 3 months that we did not lease it. And so that's 562,500. Then you have expenses. And that's depreciation. It's first one. So we had 2.5 million divided by 5. I think that's 500,000. And we're going to multiply that by 9/12. So that's 375,000. And then we had maintenance. And they told us that that was 25,000. And so total expenses. I don't know what I just did there. $400,000. And so the income before tax is 162,500. Part B says, what should be the total amount of lease expense incurred by Dunbar for the year ended December 31st, 2025? And so this is just the 750,000 multiplied by 9/12. And so that's 562,500. And if you asked me, why would you only use 9/12? It's because they're looking for the relationship for this lease. Now, the question of whether or not you put an asset that you intend to lease into service before that time, like would you have had January, February, and March depreciation? I would say that most companies would say no, that there's no depreciation happening on that asset at that time, but they could start the depreciation when they purchased it. Okay, let's take a look at example 8. Okay. So this happens when sometimes companies need cash. They'll go to a finance company and say, listen, I've got a piece of equipment. I'll sell it to you and then I'll lease it from you. And that gives them kind of that influx in cash originally. And then they have to make payments on it. So they're going to incur lease expense or interest payments, but it gives them some cash to operate with upfront. So the first thing that we've got to do is we've got to record the sale. And you have to kind of make sure the terms are all good. It does look like that the machine does not come back to Haley at the lease end. So this does look like it's a legitimate sale. And then a lease back, which is acceptable within accounting rules. If it's a sale just for book purposes and the accounting for it kind of comes back, you have to carefully check and make sure, is it actually a sale, what's happening or not. It would get reversed. You would just reverse the entry. So they receive cash, 140,000, and they have to remove the machine off the books, and that's 112,000. And then they'd have a gain on sale of machine for the difference, 28,000. Okay, then they have to record the lease. So this is also on 1/1/25. And they're going to have a right of use for the machine. and they'll have a lease, not K, lease liability. And so we have to calculate it. We have 34,784. And it says the lease term is 3 years. And the appropriate rate of interest is 6%. So if we go to the table and look that up, it gives us a value of 2.67301 for an annuity. And this is an regular ordinary annuity because the payments are at the end of the year. So this comes out to 92,978. 92,978. Now we know we have to record the payment. And when we do that, we have lease expense. And then we have right of use. And then lease liability. So we know the lease expense is going to be our payment amount, 34,784. The right of use amount is going to be 34,784, the payment amount minus, and we have to calculate what our 6% is. So 92,978. And this one, we don't have to worry about making the mistake of the payment being annuity due. It's at the end of the year. So we can multiply it times 0.06 and we don't have to subtract the payment amount. And that comes out to be 5,579. And so, I'm sorry, that is that number, but that's not the right number. So that'll be 5,579. This number is 29,205. So here, 29,205, and then the lease liability, 5,579. And then they didn't ask for it, but they give it to you, so I'm going to give it to you as well. When they make the payment, it's a debit to lease liability, 34,784, and then cash, 34,784. The reason that that's set up that way is because they make the payment on the next day. Any questions? Okay, we're going to jump to practice 1. And while you guys are here, I'm going to hand you out the team problem. I know you guys just finished an abnormally painful one, and there's not a lot of you in class today. So this will be due on Thursday, a week from today. And I told all my other classes, if you are eligible to vote, please do so. If you have to miss any part of class on Thursday, I will be understanding. I mean, Tuesday, I will be understanding. Nice. That's great when you don't have to go far. All right, so this is for you to practice. what kind of lease is this to the Kraus company? So I'll give you like 5 minutes and then we'll go over that part. You guys can work together. This is just practice for you. If you have questions, you can ask. Same with those of you on the chat. If you have any questions, you can ask and I'll put them in the chat. All right, what kind of lease is it? You don't have to, right? It says Kraus Company on January 1, 2025 enters into a 9-year non-cancelable lease for equipment having an estimated useful life of 10 years, right? So that tells you right off the bat that it passes the useful life test. And so this is a finance lease. Okay. The next one asks, what should be considered the lease term? I'll give everybody another minute. Okay, so here it says an option allowing the lessor to extend the lease 1 year beyond the lease term. And so the lease term would be 10 years. Okay, now you got to open up Excel or whatever you use, and it's asking, what is the present value of the lease payments, for classification of the lease, and for measurement of the lease liability? Okay, so let's just talk about the classification purposes. Okay, so for classification purposes, it tells us we have a $266,000 payment every 6 months. So 266 and what it does is it takes the number of periods, so 10 years times 2 times a year. And so we want the present value of an annuity due for 20 periods at, I think it's at 8%. 8%. And so we have 266,000, and they told us it was 14.13394. And so when we multiply that out, we get 3,759,628. And then we also have the guaranteed residual value. And so in this case, that was 200,000. And they tell us the rate is 0.45639. And that's a single payment. And equals 28%. It's doing strange stuff today. It's still going to show backwards. 3,759,628. I don't know why that's going backwards. Confuses me. What's that? Yeah, I have no idea. It looks cool, right? And so this amount is 91,278. And so our total for classification is 3,850,906. Okay, now, so that's part one. It asks for classification purposes. Part two says for measurement of the lease liability. And so why would they be different? Right, and so number 3 reports expected residual value to equal 120,000 versus the full 200,000. So the company will be on the hook. That's not a good hook to be on, for 80,000. So the first one remains the same, the present value of payments. And so that'll be 3,759,628. But the present value of the residual now is going to equal 80,000 times 0.45639. It's still the same factor. And so that amount was 36,511. And so our total liability there is 3,796,139. Okay, I'll give you about 5 minutes to do D. You have 3 entries. One's 125. And then another one on 2025 for the payment. And then 7/1/25 for the next payment. And I'll start the chart for you so you can use this. Keep in mind to use 4% on this one. You guys can take off from there. Excuse me. Didn't we just calculate it? Did I pull the wrong calculation? No, we just calculated it, right? Measure the lease liability. No, because they expect it to have the fair value. They're going to have to make up the 80 on top of that at that point in time. So I always feel like you should start with this table, and I'll give you the information here. So this is 141,206. So take the 266 and subtract the 141,206, and that equals 124,794. And so now our new balance 3,405,345. So because it's 6 months, we have to cut the interest rate in half. And so our interest rate that we're using is 4%. So after that first payment, we have a balance of 3,530,000. We multiply that by the 4%, and that's going to give us our interest expense, 141,206. And then we'd subtract that from how much we're paying to get how much it's going to reduce our lease liability. So then we go up to make our entries. And so we have right of use, asset, and then lease liability. And so that's the 3,796,139. And then our next entry is to record that payment, lease liability, for 266,000, sorry. And then we make the payment of cash, 266,000. So that gets us now to this value here. And so we just have to record the entry once we make that payment. And so we have lease liability. And that's the 124,794. And it looks like I made a typo here. That should be 4. And then you have interest expense. And that's the 141,206. And then our total payment cash, 266,000. And then the last part asks for what do you have to make on December 31st? So 12/31/25. And so of course we have the amortization expense, right? And this is going to reduce our right of use for asset. And that amount, because we do this straight line, 3,796,139. We divide that by 10 and we get 379,614 approximately. So that's our debit, 379,614. 379,614. And then the last thing is we have to amortize or record the interest expense, right? So 1231. And that's the 136,214. And that increases our lease liability, 136,214. So that's it for chapter 20. You'll have time on Tuesday to work on the chapter 20 group problem, and it'll be due on Thursday. All right, and then we'll start chapter 21 on the second half of Tuesday. Remember, you have the exam for chapter 19. That's going to open up tomorrow at 10 a.m. And I think the feedback that I've gotten so far that this has been pretty good. So what I'll do is I'll set the chapter 20 exam for the next weekend, and I'll just do them as one chapter rather than two chapters that don't really tie into each other. Okay. Have a good weekend. Good Halloween. Good voting time. Thank you. Have a good weekend. Happy Halloween.